much looking forward to every single panel. And the first one up that we're going to be doing is it's going to be an institutional investing panel. It's sponsored by OTC Markets Group and will be moderated by Mr. Jason Paltrowitz. So Jason, come on up. We'll get you let's give a clap to everybody coming on up. And the members of the panel that Jason will be moderating will be Mr. Len Haussler from Opus Capital Management. Len, come on up. Thank you, Len. Mr. Ralph Garcea from Echelon Wealth Partners. Ralph, thank you very much for joining us today. And Mr. Bill Nasgovitz from Heartland Funds. Bill, thank you for joining us again. And with that, gentlemen, I leave it to you.
My name tag. Thank you. Just in case.
Just in case.
Well, you started saying you invited people you respect and that know a lot, and then there's Jason Paltrowitz from OTC Markets. So thank you all for having us. My first 5 minutes was to introduce everybody, so we've already done that. But I'm honored to be moderating this panel. I have the easiest job, I guess, because all I get to do is ask questions and nod and smile. But I am delighted to be hosting this panel and, as always, to be part of this event. First about me, I guess a little bit, since I'm up here and we sponsored. Jason Paltrowitz, I'm the Executive Vice President and Global Head of Business Development for OTC Markets. I'm responsible for our listings business as well as our trading and market data business development. For those of you, Pink Sheets was mentioned in the remark. We are the old Pink Sheets. For those of you who remember the books. Bought the company 20 years ago and turned it from a publisher of stock quotes that came out once a week to what is now an SEC-regulated, FINRA-registered ATS, and the home to over 10,000 securities, many of which are the microcaps we're discussing here, including the Singing Machine, which trades on our OTCQX platform. Those securities, we turned it to an electronic market, and we put criteria in place to allow investors to discern investable from not. We all remember the old Pink Sheets days, the pump and dumps, the dark, the distressed, the bankrupt. When American Airlines went bankrupt, it went to pink. We've been spending the last 20 years trying to clean that space up, trying to give investors the information and the data they need to make investment choices that they can count on by giving them the information and trying to be open and transparent. So that's kind of a little bit of a segue to three gentlemen that spend their lives thinking about these things and that invest in the microcap space. So what I wanted to do was start with each of them kind of giving you 2 or 3 minutes about themselves, their background, and just introducing themselves. So we'll go straight down the line. And I'll start with Len. If you can just kind of give us a little bit about your background and where you are right now.
Sure. Can everybody hear me? Yeah. Great. Well, my background is a little bit different. I'm a CPA and a CFA, and I first started off with the Meade Corporation, where, in a sense, I was a person behind the president who would give out all the information to the stock people and the analysts and the like. From there, I went to Cincinnati Bell, which is a small utility. I became the director of investments there. So there, I would be the one who would be hiring and firing investment managers and the like. I wrote the investment policy statement, so directed all the investments for the pension fund, the savings plan, et cetera. And then sort of in the middle of that career at Cincinnati Bell, my boss walked into my office and said, you know, I'd really want you to develop a system for picking stocks internally. And it's like, gee, okay, sure, I'll do that. And so I spent 2 to 3 years researching what had worked well over long periods of time. Unfortunately, we got a new CFO in who, right when we were going to flip the switch to manage money internally, he said, no, I don't want to do that. But that formed and that sort of stuck under my skin, to be perfectly fair, since I did 2 to 3 years of research on it. But that was the genesis of Opus. So what we learned in our research was that we liked small cap value stocks, and that's what Opus has been doing for 20 years, and that's the story.
Okay. So I'm Ralph Garcea, aerospace engineer by training, and worked at Bombardier for 5 years developing software for modeling aircraft. Used that to move down to the States. I was down in Michigan for about 3 years selling software, right around the Netscape IPO, so I'm dating myself. Used that to come back to Canada and become an analyst, and I started off at a large Canadian bank and been doing this for 20 years now on the research side. I was fortunate enough to work for 7 years with Credit Suisse under Frank Quattrone. So if you were a tech analyst at the turn of the century during that tech bubble, you really wanted to be with that team, and I was lucky to move over and work with that group. Worked for Cantor for a couple of years, so getting the experience across large Canadian banks, some global firms, and some smaller boutiques where I am now. Echelon, I think, is the preeminent growth boutique in Canada. We've got about 4.5 billion Canadian in assets from our retail arm, and then we got a full brokerage firm with 8 analysts, and we're looking at. We just celebrated our first anniversary as a boutique, and hopefully there's more good things to come from Echelon.
Moving back to America. Bill Nasgovitz, Heartland Advisors. My love affair with small stocks has been a long-term deal. I began investing in small companies back in Milwaukee, Wisconsin when I was age 12 with paper route money. My father was a teacher, but I scraped enough money together and just became totally wrapped up in stocks. Starting to hang around regional brokerage firms. After graduation, went to Dean Witter because it was a family-run partnership out in San Francisco. Followed smaller companies, regional companies. Couldn't break in as an analyst because I was too young, but or maybe just plain unqualified. In any case, was there 10 years, did well, and decided to buy a more or less broken down brokerage firm, which we turned around and began the investment advisory business there in 1983, Heartland Advisors. Launched our small microcap fund, the Value Fund, in 1984. So it's 34 years old. I still am the lead manager, but fortunately I've got some younger, smarter people, CPA or two, or an engineer who provide a lot of brilliance. We've got a staff of over 16 of us, over 300 years of experience, and the Value Fund still is number one in its category. We're in the value mode, so it's a nice contrast, I think, between the three of us. We should be able to give a full spectrum of our thoughts in terms of the small micro-cap market. We manage about $2 billion in 5 funds and private accounts, employee-owned, passionate people. All we do is value.
Great. So clearly diverse backgrounds, yet you all somehow came around to microcap investing. So I guess that leads me to the first question, which is, how do you approach it, right? You've got diverse backgrounds, you've come different countries, different places, different parts of the country. But as you look at microcap investing, kind of how do you approach it? What are your strategies? What are you looking at? What makes you happy? Start, I guess we'll go down the line again, or if anybody wants to jump in.
I'll start off. We have 3 small/microcap strategies, and I would say that the microcap strategy for us is the most quantitative one. So in that regard, we feel like we should have more stocks in the portfolio and have less stock-specific risks. So in the final analysis, we have about 120 stocks. The way that we look at it is we are looking to have 3 characteristics, if you will, that should outperform over long periods of time. The first thing we look at is valuation, similar to Bill. So we are looking for, when we talk about valuation, we're talking about generally PE, price to book, EV to EBITDA, and also free cash flow yield, which we found works pretty well with the industrial companies. So again, why do we go down the valuation route? No offense, but we think value wins over long periods of time versus growth. We can battle
Our
it out
first
later.
controversy. Sweet.
Drop the gloves.
We also look at momentum, and for us, momentum means the 1 month change in the 200-day moving average. We've also found that over long periods of time that momentum, in microcap especially, is helpful in terms of determining performance. And lastly, we look for quality. So we're looking for return on equity, i.e. we want it to be very, very high. We also want relatively lower leverage. And both of those factors do add a little bit of performance, but in point of fact, we use those as risk measures. So when the going gets tough, and we haven't had any tough periods of time for the last 8 years, but if we were to have any, the non-earners and the highly levered companies typically underperform during that period of time. We want to make sure that we outperform in the down markets. The other thing that we do is that we refresh the portfolio quite often, so 2 times a quarter and 8 times a year. And that's pretty much it in a nutshell.
Okay.
If I could jump in,
Bill.
since we're on the value side as well, and we've got you in the middle here, the Oriole look. But in any case, how we approach micro, the value fund is about an $800 million fund, so that's a sizable fund to be investing within this sector. What's our definition of micro? Morningstar, by the way, has a $1.3 billion cutoff. We're down to 300 million or less. So we have a barbell approach within the fund. We have both small and micro. We'll go up to 2 billion on the small side, and under 300 million. We have no minimum on the downside. So we'll look at the smallest of the small, and that somewhat sets the fund apart from its peers. We've got about a $330 million median market cap today. We're value-based. Why? Because back to Dean Witter, 73, 74. Anybody remember that bear market? Raise your hand. That means you're oldie. Where's Mr. Senior Craft? He would remember it. The average stock was down 70, 80%, so I thought, this is, Dean Witter's not making, ideas are not making me any money, my clients any money. So I reread Benjamin Graham and The Intelligent Investor and developed essentially a 10-point checklist based on fundamental earnings, cash flows, all that good stuff, and some qualitative issues too. So we use that as more or less our summary page for selecting and selling stocks within this sector.
I love talking to American or to U.S. PMs because microcap's 1.3 billion or 300 million. In Canada, microcap's 30 million, and the landscape's littered with 5, 10, 30 million dollar companies that went public too early, didn't make it to profitability, and just get orphaned, and there's no one covering the stock. And so what we look for, we see companies, as you guys do, with business plans that show 10, 20, 40, 80, 160 million in revenue over 4 years, and 1 out of 1,000 can do that. So you got to pick that management team that you feel comfortable is going to be able to deliver that kind of growth for you over 4 or 5 years without stumbling. So that's what we look at first, fundamentally, is can the management team do that? Those are sort of the hurdle rates that we look for in the growth names, the 10, 50, 100, 500 million, and then $1 billion. Do you have the right systems in place to manage that kind of growth without sort of getting overwhelmed and run over by that opportunity? From a Canadian standpoint, most Canadian companies will do well growing to 5 million in the home market, and then how do they grow globally? Can you compete in the U.S. against U.S. companies? We'll look at that. Did you skip the U.S. and go to the Middle East for some reason? There's a flag there. Or can you grow from Canada into Europe, use sort of the calming culture to grow your revenues that way? So, it's tough to manage that, but there's 2 or 3 flags that we'll look at. We see 5 or 6 companies a week, and then you sort of got to pick, the handful that you want to follow as a firm.
We have close to 250 Canadian companies that are cross-listed on our market. So we see what you see in the market. So I guess I'll go to kind of the $1 million question. Is you guys all have different strategies. You look at different things, but we're all looking at the world right now. So I'm sure everybody in the audience would like to hear, what do you like right now? What's looking good? What are you focused on? What do you see that's kind of getting you excited? And I will say, I've been told I have to say this, if you mention a particular stock, please let us know if you own it. But to the extent you're not going to do that, if you could talk about some sectors or some things that you think are looking good right now. And
Well, I'll start with, as fundamental investors, we do a lot of tire kicking as well, seeing hundreds and hundreds of companies in the course of a year. So as value investors, we're trying to limit the downside risk. So we're looking for safety nets and perhaps a bit contrarian. Companies are out of favor. So what's been out of favor? Apartments have been the rage here for a number of years, so we've liked the home building sector for a couple years. Just recently, around the election, you could buy home builders at book value, This is when the S&P is trading at multiples of book value, right? 3 times plus book value, when it's a rarity to see that. So they have earnings. In some cases, they pay dividends. And people just are betting that interest rates are going to go up and home builders are going to get killed. We don't think so. We don't think rates are going to go up that much. That's one area we like.
I think on our themes, one is, you look at the e-commerce theme, and I'll try to get through this without mentioning specific names, but you look at e-commerce and it's probably 10% of overall retail spend right now and growing nicely. So you want everything from the companies that set up websites and provide that, the back engine to allow you to sell goods online, to domain registration names. If you want to set up a company, snn.com, you're going to have to pay $9.99 a year for that domain registration. To you finally order something online, you're going to need a truck to deliver that to an airport that gets on an airplane. So anybody that's sort of involved in that delivery side of it, we cover industrial and transportation names. To anything that helps you file online, because now between the U.S. and Canada, you're going to have to file a manifest to register those goods in order to get it across the border. So I've got companies across that whole spectrum. And then the consolidation theme. You continue to see it both in IT services and software. Everybody says this consolidation is going to end. Well, it's been going on for 20 years, right? As VCs put money into the space, you're going to have these companies that sort of hit that 5-10 million wall that get rolled up into the larger names. And that's going to continue. I mean, if you look in software, there's only 50 names globally with more than $2 billion in revenue. There's 30,000 names with 100 million and less. So that consolidation theme is going to continue, i.e. that's why you bet on management. Have they done it before? Do you feel comfortable that they can continue doing these acquisitions? IT services, not as many names, but it's going to go to the large. I mean, as a CIO, you want to wring one neck, right? If someone's doing a development or a digital transformation within your company, you're either going to go after the IBM neck or one of the larger vendors. So if you're a smaller player playing into that, you really want to have a niche product. So whether it's cybersecurity or you're developing a solution that someone like an IBM or an HP or a CSC is going to find a value and pay up for that from a consolidation perspective.
And exporters of Canadian lumber?
No comment.
Okay.
I do own.
On the advice of Mr. Trudeau, no comment.
We do own one, headquartered in Vancouver. Pays a 5% dividend. It's selling at 6 times earnings. A little debt, lots of cash, good management. Totally ignored in Vancouver. Pay him a visit, would you, Ralph? Buy some stock.
And we would agree that the home builders, we actually have some positions in home builders also, but in terms of our portfolio right now, we're a little bit heavy in financials. I would say that the banks sort of took it on the chin during the first quarter, but given that interest rates continue to rise and that that particular area is ripe for consolidation, we feel like small banks will continue to consolidate, and that should be a good area to be in.
Okay, I'm going to switch gears a little bit. That's the positive. So we're all in the micro-cap space. We know it's fraught with potential dangers, right? We hear it. I think the SEC came down with a 27-count indictment recently for anonymous pump and dump promotion, right? There's all sorts of risks naturally within the space. We all make it our mission to try to weed through those risks. Certainly we do at OTC Markets. But I wanted to ask, as you're looking, since we're talking about looking at investments in companies, are there red flags? Are there things kind of when you're looking at a company's history and what it's done, that maybe you look at that and say, I'm going to steer clear? Just certain examples, reverse splits or certain convertible debt financings. Are there things that a company does in the management and the day-to-day and trying to raise capital that any of you, and you can jump in wherever you want, would look at and say, that's kind of something I'm going to steer clear of?
Well, in the small cap area, we like, especially micros, we like companies that have pristine balance sheets. Low debt, no debt, lots of cash. You remove the financial risk. That's one thing that we like.
Yeah, I mean, for the growthy names, we hate debt, some of those death spiral financings, especially when a company's in the middle of a transition from an enterprise software product to SaaS, let's say, where you were used to doing $1 million license deals where you'd get the cash flow up front, and now you're going to $10 per user per month, paid out monthly, and all of a sudden your cash flow dies, and you can't service that debt, and you lose your company. So we try to avoid those, those names on the growthy side and the startup. For our larger names, I mean, we do follow a barbell approach. We prefer debt and we prefer dividends, and because it just instills this. They're much more comfortable, management is, of either doing the wrong acquisition. If they know there's a dividend payment, and even with a 25 or 30% payout ratio, they're going to be much more careful in some of their strategic decisions in making the wrong acquisition. So, this sense of discipline on the large cap side, and definitely avoid debt for the microcap names, because it's just it's way too dangerous.
Well, I guess it's unanimous. We all hate debt. The one that I would think that we've learned, I guess sometimes the hard way, that's a little bit different and you wouldn't really think about it, is a high short interest. And I have to say that when I went to school eons ago, and the articles that I always read is, a high short interest, those doggone shorts are going to have to cover, and you can make a fortune short covering. Yes, yes, yes. That has really not been our experience, to be perfectly fair. That's not to say we haven't bought stocks that have a high short. But in fairness, it seems like these guys, the shorts are, number one, they're pretty smart, and number two, they will do anything to win, right? So again, you're in a microcap universe, very illiquid for the most part, and somebody's spreading some story, and it doesn't matter if it's true or it isn't, the stock can just plummet. So what we have found anecdotally is that yes, you can make a fortune when there's a high short, but only when it's coming down, not when it's already at its peak. We actually wrote an article about that. So what we've discovered is that if there is a high short interest, not that we won't buy it, but it is the red flag that we need to determine, okay, somebody is betting against this. We have to be very convinced that we're on the right side of that ledger before we make a bet on that.
Jason, you mentioned reverse stock splits. I think that's somewhat maligned. I'm thinking back, we owned Priceline way back when, off of the 2000, 2003 new era bear market. You could buy it dirt cheap. It was a value stock then. They had a reverse split, and we sold it way too early. So there are perhaps some vivid examples of reverse splits in some of these broken stocks with the right management, the right strategy. They can be huge winners because they lower that share count big time. I think it was it a 1 for 25? I can't remember. It was huge.
Okay. Anybody else? Anything to add?
I think insider ownership, especially for the microcaps. I mean, you want management to be aligned with investors, and normally we like to see 15, 20% plus of insider ownership. If it's less than 2% or whatever, and management doesn't have skin in the game, and they're collecting $250,000 salaries or whatever, it's normally we'll consider that a flag.
That just brings up another question, boards. How closely do you look at a company's board's corporate governance in the microcap space? Certainly some of the listing requirements on our market for QX, we've put some minimum board requirements, a couple of independents, an audit committee, nothing to the extent that the national exchanges require. But how closely do you look at a board? Do you look at the quality of the board? Whether or not the people in those seats, certainly on the audit committee, are CPAs or have financial backgrounds? Do you spend a lot of time on that?
Well, that's been one of our biggest mistakes, not paying enough attention to boards, and we're trying to get better at that. So it's a hot issue at Heartland, and one that we're spending more time on. And again, it comes back to ownership, how long these people have been on the board, especially if it's a turnaround. My gosh, are there real changes afoot, or is this just a lot of lip service to, the new tactic?
It's definitely important. I mean, if the CEO, founder surrounds himself with friendlies, obviously they're not going to make the right decisions for the company. So it definitely is important from our perspective.
It becomes important when the company's in trouble, right? And I think that's when you sort of delve into it a little bit deeply.
But do you look at it? So I
Prior to
guess
that,
for
well, we're only
for
looking
you
at-
as a quantitative investor,
It's
I
a
guess.
little hard. We would, even though we're quantitative, before it goes into the portfolio, we do look at it from a fundamental basis, but we would probably look into that a little bit more deeply if we're getting into a situation where it's, they've had problems in the past or something along those lines.
So I'll jump right to you. How do you pick potential investments?
Well, as we said, we are, for this product, more quantitative than not. So again, this universe, and everybody's got their own definition as to what it is, but if you're looking at what the Russell people will say it is, it's, of the 4,000 largest capitalization companies, it's the lowest 2,000. We actually look between 50 million and 750 million in terms of capitalization. And we also look for, it has to have a certain amount of liquidity for us. It's a little over $100,000 a day, and it has to be at least $2, which is actually $1 more than what the index would look for. But that's 2,200 stocks. So there's no way that, so what we do is we do a lot of screening. So the first thing we do is we look for the lowest 40th percentile in terms of trailing PE. Now, this universe is 35% non-earners. So in our minds, you have to have an E to have a PE. So already we've eliminated quite a few of the companies. The other thing that we would do is look for a secondary indication, and we're basically eliminating, and we typically do this by quintiles, we're eliminating those companies that have the highest quintile in terms of leverage for their sector and or industry, et cetera. We also look for those who have the worst earnings growth over the last 12 months. We also look at momentum. Again, we're looking for the ones that have the worst momentum, so the lowest 20th percentile. And lastly, anybody who has negative free cash flow, they're out. So when you do all of that, you actually end up with, starting with 2,200, you're already down to between 250 and 300. So from there, then we switch to looking for what's good, if you will, and we rank them based on valuation, which is 50% of the equation. That's a combination of PE and price to book and dividend yield for financial stocks. It's a combination of PE, price to book, EV to EBITDA, and free cash flow yield for non-financial stocks, and we simply rank them, and then we start at the top, and that's where we start looking for our fresh ideas.
I mean, it's my job to screen the names that come through. Again, we see 5 or 6 companies a week, and eventually when it sort of, okay, we want to, I like that company, we'll bring it to a new names committee, and then most of the senior management will decide whether we want to back the company. Once we back a company, it's cradle to divestiture, hopefully. I mean, we'll be there for the capital raises to help them grow, and hopefully for the M&A mandate if they get acquired, or for the M&A mandate if they're going to do acquisitions, and then we'll help fund them.
How many meetings on average with a company does it take before you decide to write the check? Would you
Normally
say?
for us, it'll be probably 3 or 4 internally. I mean, again, on that first meeting, unfortunately, I'll make the decision whether we pursue it and bring it through the rest of the firm. Sometimes we get referrals from our retail. Again, we got over $4.5 billion in assets. They've invested on some friends and family rounds. They'll bring the company in, and you get into a problem there when I don't like the company and they've invested in it, and someone gets upset there, and you got to be diplomatic about it. But so it does get screened properly before we make that decision, because again, we'll put the whole firm behind it and make that commitment.
Well, Jason, our ideas will come from a variety of sources, perhaps a name that we knew 20 years ago. But let's put this in perspective. The U.S. economy is growing 1% or 2% a year. The market's tough for active investors right now because of index, this pervasive passivity, the love affair with the S&P 500 or the leading ETFs. So as active investors today, Heartland has to be more focused on companies that are in unique niches and growing their sales and earnings. So we're not stepping out of our value parameters of low PE or free cash flow, some of the things that we've heard here before, but we've got to find companies that are growing faster than GDP, that are, especially if they're not in the index, in an index, which 40% of our names are not, that are going to attract potential buyers. So there has to be an extremely strong catalyst. What's going to ignite your interest in buying XYZ or that lumber producer up there in Vancouver? So a strong catalyst with some top line and bottom line growth potential is very important to us today.
So I'm going to shift a little bit to research. Shelley was talking about the good old days, right? In the good old days, research was all the rage, certainly sell-side research. All of us are in MicroCap, so we know that that's getting harder and harder and harder. For you as investors, I would imagine the types of research that you get to look at when making your decision gets thinner and thinner and thinner. We're starting to see more and more of company paid-for research. Certainly there's good and there's bad, that 27 count indictment being the bad, I would think. But for kind of the microcap companies in the audience that have to face this challenge every day, you know, how do I get my name out? How do I get it in front of you three gentlemen? Do I pay for research? Where do I go? I'd like to get your thoughts on a couple things. A, your thoughts on paid-for research. B, your thoughts in this new environment of the importance of research in general. And then I guess the last thing would be some guidance or your thoughts on what you think small companies should do to kind of help get their story out in the absence of research, or depending on what your feelings are on paid-for research. And I'll start again, Len, since you're closest to me, with you.
Well, I would not read it, but to be perfectly fair, we look a lot at, even in the products where we're, again, we've got a whole scheme of small cap products. We have ones that are very fundamentally focused with a little bit of quant, and then we've got this one which is more quantitative with a little bit of fundamental at the end to make sure that we're not getting ourselves in trouble with a purchase. But in fairness, I tend to be somewhat of a cynic, and in terms of reading research, I'm not all that, I'm just looking for the facts. So obviously the analyst has had a little bit of closer contact to the CEO or CFO or what have you. So again, you might get some nuggets of information there, and I think that the brokers or the investment houses bringing companies to light, at least it will make you take a look at the company. So I think that's a good thing. But honestly, I would say that I'm not all that much of a fan of believing what the CEOs are telling me either, to be perfectly fair. So and I guess that's from personal experience. When I guess I've already named the company that I worked for, but in terms of there are times where the CEO, in a sense, becomes a salesman for the company because of options they hold or what have you. And frankly, we are big believers. If somebody says they're a good allocator of capital, you know what? I'm just going to look at their ROE for the last 10 years, and I want to see if they have write-offs and the like, because they can say what they will, but the numbers are there for anyone to see. So I think it's good for these companies to get their name in the paper or maybe in front of the three of us, but in perfect fairness, I'm not a big fan.
Ralph?
I mean, research was easier 20 years ago when you got paid 10 cents a share. Now you're getting a quarter penny on on the microcaps. You're even lucky to get that. So, you try to remain objective as an analyst and put the pluses and minuses of a company out when you do publish research. It's, for us, being at a boutique, we'll do a barbell approach. So there's 8 analysts at Echelon. I'll cover companies that are 10 to 20 billion in revenue in market cap, and that'll get us into the agency flow, and we'll get paid from that side of the business. On the microcap side, you follow it because you love the company, and hopefully you'll get paid through financings as you help them grow and through the M&A advisories, et cetera. So it's not a direct pay for service per se, but and that's really the only way to survive in Canada. I mean, there's been so many of the smaller boutiques that were only mining focus that have either gotten acquired or have closed doors. So you got to be strategic in your coverage universe, and then that's the path that we've chosen.
Will that change under MiFID II? Are you going to see that trickle to Canada? The decoupling fully decoupling of research to trading?
We'll see. I can't see that coming to our markets, but we'll see. But it's definitely been that 10-cent to quarter penny that's sort of driven a lot of these barbell approaches. I mean, you got to be there covering the larger cap, the dividend payers, to get a full spectrum of portfolio managers when you go marketing. Otherwise, you're just going to be too nichey, and in a downturn, you end up getting in trouble as a firm.
In terms of paid for research, we rarely look at it, so that's not one of our interests. There are some good IR firms around, at least in America, that I know of, so I'd go that route with an experienced, qualified pro, and I think you can get more bang for your buck that way in terms of a company, an issuer. In terms of research, we do rate providers, so we might have 40 different brokers calling on us for our 5 different funds in different areas, but we rate people and have for almost the entire history of the firm, 30 years, A, B, C players, and we allocate our commission dollars accordingly. So we bring them in every year, celebrate some successes and some pointers in terms of how to be better. So that they are important to us.
Just to add, I mean, on the microcap side, there's some names I'm the only guy covering the name, and I don't mind that at all, especially as you watch the stock go from 10 cents to $2, and then everybody else comes on. And I would agree with the IR comment. I mean, the companies where I'm the only guy covering it, the CFO is doing everything. So if there's news out or he can't answer calls for retail customers or retail clients or portfolio managers, so it's that $3,000, $4,000, $5,000 a month that you pay for an IR firm just to keep you in the flow and get press releases out, I think is money well spent for microcap names.
Okay. I have one last quick question, and then I think we're going to open it up to the audience. So this will be a quick one because we see it a lot. Again, we have 10,000 securities, many of whom have a problem being on time in their filings for whatever those reasons are, and I'm sure a lot of you know what I'm talking about. When you see companies that are consistently late in their filings, what does that say to you? And how do you feel about that generally? Does that dissuade you from investing?
Should have sold the stock the first time it happened. That's been my history. But some of the smaller companies are late because they just don't get the time of day from their CPA firm. They're on the bottom rung of the totem pole, so to speak. And I think that's a legitimate issue for them. But we certainly urge, hey, in this day and age when, Alcoa reports the 5th or 6th business day, they're a global company. Come on, guys, you've got to get your act together. And it's something that we look at before we move into a stock.
And it is a flag. I mean, I go back to that 10, 50, 100 million, 500 million level. You guys still have entrepreneur-owned companies that are 50 million managing his company on a spreadsheet. He should have moved to Dynamics, or I'm not plugging Microsoft, but ACPAC or some package when he was 5 million, just so he can be ready to sort of help him with that growth. So it is a flag. I mean, it's more a testament to the IT systems and the financial systems not being up to par for a public company.
Well, coming from the Treasury Department, for most of my prior experience before I was an investment advisor, I'd say I'd fire the CFO immediately. But at the very least, I would consider it to be senior management problems there, and that's a really big red flag.
Okay, thank you. So with that, we'll open it up to the audience for questions. I would ask the question, and then I have to repeat the question. So if you guys could just give me a second to try to repeat the question for the audio. And Shelley?
My question is, a lot of your answers so far to the questions were, when do you buy? What do you look for? My question is, when do you sell? Whether it's happiness or sadness that brings you to that conclusion. What are some of the targets that you would use, potentially percentages above what you take?
So I will paraphrase for the audio. Shelley has asked, when do you guys dump a company?
Well, let me jump in. As a value investor, this is one of our biggest mistakes as a firm, that we overstay values and value traps. So we're trying to get better at this as well. And we have various criteria, of course, within our 10-point checklist, so to speak. But if a company would run out and lever up, that might be the reason, and we've done that in the past, and we'll do it again. We'll sell the stock immediately. I think perhaps one exaggeration is okay, but the second one might be considered not telling the truth. So if you're starting to see a pattern of management is just plain out misleading, we're gone.
I think tied to that is management turnover. I mean, if the CFO leaves, or the head of global sales, or the head of IT services, whether they say in the nice press release that he left for personal reasons, or he's another opportunity, et cetera, that's normally a sign. His options are underwater. He's not going to make his numbers. He's leaving, right? So you should probably follow him out the door. And then if a tech company, if a tech company misses a quarter, you know what happens, right? The stock's down 20% overnight. So you got to make the decision as an analyst: did they miss the quarter because they're losing to competitors, or because they're chasing elephant deals and they got delayed a quarter? So it's going to come in next month anyways. You know what? Take that 20% hit, buy more the next morning. Nothing's changed competitively. It's still a great company. You want to own it. So I mean, you got to make that decision overnight. You've been following the company, so you know competitively if the industry is changing, and if they're starting to lose deals to the bigger players, or to some new entrants, it's time to leave. Take that 20% hit, and move on to the next growth stock. But if it's only because a deal's delayed, normally you're going to see it the next month. The stock will recover, and you look at most of the companies I cover. If you bought on the dips, you're up tenfold over the last 10 years. You'll be very happy.
It's always easier to sell when it's a success, right? So we're buying companies that have below average PE. So when it has an above average PE, easy, we sell. But I would echo what you said earlier in terms of, and I think we've experienced this too, certainly and I think that we learned this from our fundamental bent, where we feel like we know the company really well, right? And it's become cheaper still, right? And you're tempted to buy more, or at least hold on. And frankly, we've looked at our history over the 20 years, and we've really, on occasion, held on too long. So with this particular product, the tack that we have taken is that we let the winners run. We will cut them back if they, double or something along those lines. We'll cut them back to our normal weighting, which for us is like 0.8%. But we sell the losers early. So for us, if it's between meetings, if it's down more than 15% versus the market, it's history for us. So, and we have found that when we look back at our history, if we had done that with all our fundamental products, we actually would have done better. So with this more quantitative product, we actually, again, the theme is let the winners run, sell the losers early.
In the back.
So I'm just a private investor. I don't own a Bloomberg terminal. And I find when I'm looking for quantitative data, I find that sometimes there's disparities in sources as far as stock screeners or just looking at different ratios. Which sources
Again, I'm going to paraphrase. The question was around quantitative data and what are the best sources that you look for or that you've found to be sources for reliable quantitative data. Did I get that? Yep.
Well, I would say unless you have like $120,000 plus to spend on FactSet, which is what we use, you are in trouble. Because even with FactSet, we print off one-page summaries, and every once in a while we'll come across something, we'll look at it, we'll say, oh, the ROE is 120%. I don't think so. So again, it's a problem that professionals have. Even when you're spending a fortune on data, there are problems, there are issues, there are NAs everywhere. So I guess I would say don't feel badly, but it's just you have to be careful on all the data that you subscribe to or see in the paper or what have you.
For MicroCaps, it's your own spreadsheets, right? I mean, normally we're building most of these models ourselves because the historical data may be fine, but there's no analyst covering the company, so you don't get any forward estimates. So you're building your own models and databases. If companies are followed, I mean, it's a toss-up between FactSet, Capital IQ, I think, on the tech side. I mean, they've got, Capital IQ, I think, has the better global database. So if you want to bring in a full comparable look at Asian, European names, North American, I think Capital IQ's got the better data set. But in the microcap world, it's really tough to find estimates. So normally we're just building models of any of the companies that we've seen.
And
I'd echo that.
I would echo that. If you're looking at international companies, FactSet is not the one you want to use, I'll just tell you.
So build your own models, but hey, rely on the company's filings. That's public data you can access pretty easily.
So cheap plug here, all of our OTCQX companies get Morningstar quantitative research reports, and they're available on our website, and they're updated daily. So that's 400 some odd companies where we're making that quantitative analysis available every day. There's a question here in the front.
And this is somewhat pointed at Ralph because of the Canadian experience, but all can probably deal with cross-border issues. So the number of public companies in Canada has dropped significantly. I think it was 16.7% down since 2007 in a recent report. So are you seeing a lot of companies looking to do cross-border listings like you used to see back in 2000 timeframe where everybody was cross-border in that sense if you're a non-US company?
So the question was around cross-border listings, I guess specifically Canada, but not necessarily. Are we seeing an increase in the number of companies that are looking to dual list? I will say Canada was our hottest market for the last 3 years for dual listings, over 200, as I said. So we are seeing a huge uptick this year, but I'll ask these gentlemen.
You're starting to see more and more of it. I think you're starting to see U.S. companies coming to list up on Toronto first, either startups who are tired of the VC path, the private equity path. They'll come up to the CSE or the venture or the TSX, depending on their size, and do their first listing be after a friends and family round being a TSX listing. So that's an interesting trend from the tech side. The disappearance of companies, I mean, flows into the consolidation comments I made earlier, and that's why my title now is Technology Diversified and Gaming Analyst. I used to be just a tech analyst back in the mid-90s. Most of my companies have gotten acquired, so you cover a broader array of companies now, and the dual listing helps for the larger cap liquids. So, the large cap gambling names, the large cap software names, IT services names that I cover, you definitely see the north-south flow, and that helps as
Cannabis?
Cannabis starting is still early, I think. We'll probably see it, I think, within the next 6 to 12 months. And also, flowing over into the LSE in the UK, where you've seen some dual-listed names, Toronto and LSE.
You bring up an interesting point in terms of number of issues publicly traded in Canada It's down here in the U.S. We're down, the Wilshire 5000, I believe, doesn't have 5,000 stocks in it. So it's less and less. Why is that happening? Regulation, increased regulation, concentration, industries concentrating, M&A and all that. Also the rise of the venture capital industry. Why go public? Why go through that rigmarole? And we'll just get a VC pay $20 billion for our company and not go through the hoops that the SEC and the government put on new companies. So it's a disturbing trend. We'll see if it changes.
Question, I'm going to try to get the right side of the room. I've been favoring the left. Is there a question on the right? Because there is one on the left. All right, they're beating in the back.
Hi, when you have a company, a stock that's primarily retail owned, it's too small, too early, but it's growing and in share price liquidity, what are the things that you have to see at the minimum to feel comfortable owning it as it's going from retail to institutionally owned?
So the question is on the transition from retail ownership to more institutional ownership. And one of these three gentlemen, what do they look for as a company makes that transition to more institutional ownership in their shares?
Well, outside of valuation, liquidity, can one buy into this company and make a difference for a portfolio? And Len had his cut off, and we might have one as too. You know, if we can't buy $1 million worth of it, we're not going to buy it.
That's probably the biggest factor, I think, is the liquidity side, and then just visibility. As you're starting to show the company to institutions, they want to make sure, is the company at a 10 million run rate, is it profitable? What's the next leg of growth? Where is it going to come from? Because you could get into the institutional side by, a potential acquisition and doing a capital raise to fund that acquisition, and that's when you get your big three institutions, right? So you go from an 80-90% retail to a 50-50 possibly off of an M&A deal and a financing.
Just to that point, because we see this all the time, and it goes back to my reverse split question, I guess, right? Companies that don't have a lot of shares outstanding, that don't have enough for you guys to make an investment while they're thinking about reverse split to keep a price at a certain place, they could be doing themselves significant harm if now they've just reduced the number of shares and the availability of institutional investors to get in. So, I mean, we see NASDAQ companies do this all the time. They're just trying to stay on NASDAQ because they think they're going to get institutional investors being on a national exchange, but they reverse split themselves right out of the pool. So definitely things you need to think about. And I'm sorry, Len, I cut you off a little bit.
It's the same. It's liquidity for us. We've already stated what our needs are. It has to be at least 50 million, 100,000 plus daily volume. That's what it really is for us.
Shelley.
But you raise a very interesting point regarding, the frenzy to uplist. And, I see that there are a lot of registered directs going on and active markets going on, and a lot more shares coming into the market. And then these companies, want to uplist and reverse it and try to do another underwriting all at the same time. What are your feelings on this uplist frenzy? How does that affect liquidity, especially if you're either in the stock already or potentially looking to get in?
The question was about the uplist frenzy, I'll use that word, and what the thoughts are about companies that are in this rush to potentially uplist and what they feel about that, what that does to the investability. And again, I guess to my earlier comment about some of the things you need to do to stay on a national exchange, does that actually hinder more than help the perceived objective?
Well, I've got a comment. This has happened over the past month or two where companies are now saying, and in Canada as well, a fellow was just he has a roughly $500 million company, and he's being told by whomever in Canada that he has to get to $1 billion in terms of market cap so that he will receive interest from the passive community, whether it be an index fund or an ETFs. So his dilemma is, gee, I'm not going to rush out and buy somebody. I'm a value guy. I'd like to buy things cheap, and I'm not going to lever the balance sheet. So what's his next alternative? Well, perhaps sell out. I mean, cash in. So again, it's a real issue. I'm not really that familiar with uplisting, but I think this is a primary issue for small microcap land.
Yeah, and you see it with the weed stocks now. I mean, we do have a weed analyst, but, you know, they'll start on the CSE as their initial listing, and, I mean, some of them have gotten to 200, 300, 400 million on the CSE, and then, you know, they'll migrate to the venture, to TSX directly. Some funds can't buy stocks in Canada, and I'm sure it's the same here in the States, if it's only CSE listed or venture. Some of the larger funds, you know, you got to be up on the main board for the fund even to look at the stock. So, you know, you do get into that dilemma as you're trying to attract that, you know, that larger shareholder and pension fund, et cetera.
I would say that, you know, maybe we're part of the problem in the sense that we will only buy stocks that are New York Stock Exchange or NASDAQ listed. And I think that part of it is the index itself. Like, for example, the Russell Index itself will not consider OTC stocks, pink sheet stocks. They just won't. So, again, I think we're somewhat of a victim of, if we're being measured against a benchmark as an institutional investor, we generally would, not that we wouldn't buy things out of that, but frankly, over the last, especially since indexing has become so prominent, when you're buying stocks that aren't in the index, it becomes a problem. So what we're seeing is that performance is actually better for stocks that are within the benchmark. And that's because all this money is flowing in the ETF. Now, it's somewhat artificial, and you'd like to think as an active manager that would reverse itself. But right now, it's a problem. And if you were buying stocks out of the benchmark, that has led to underperformance, to be fair.
Just the SEC's done a lot of work and studies and a lot of academic studies on this, which are actually very interesting about market caps, where to be on exchanges, the differences between how exchange securities trade versus how dealer markets like ours trade. So for anybody that's interested, there's a ton of research out there. One of the most interesting things was the SEC found that for stocks under 350 million, the primary 85%, I think, is self-directed investment, and that you don't actually see that increase in institutional ownership just by moving exchanges. There are a lot of other things that go into it, but I digress. I think we're done. I'm getting the cut. So please join me in thanking our panelists.
Pleasure meeting you, Roger. Good luck. I have somebody give you a look.